Welcome back to the part 2 of this mini educational series on affordable home loans. My name is Christabel Ojok from Rentsco, and today we are pleased to be joined by Elijah from Absa. So we'll be tackling a couple of questions which we didn't manage to cover on the first session. So Elijah, thank you so much and welcome. Please introduce yourself to our audience.
Yeah, so name is Elijah Toili. At Absa, I am in the mortgage department as a business development manager, just supporting our branch network to be able to deliver on mortgage across end-to-end segments of the industry. I have been in the banking industry for a while. Totaling to around 18 years, 16 of which I've done mortgage.
Okay.
So yeah, I'm passionate about it and really looking forward to a very interactive session. Yeah.
Okay, and we are glad to have you here.
Thank you.
So the premise of what we do at Rentsco is that we are championing affordable home ownership, primarily for first-time home buyers. And the best way for anyone who wants to get started is for them to leverage affordable home loans. So essentially, what the platform does is it matchmakes. So when you go on the platform, you're able to use our affordability calculator. Mm-hmm. You key in your income, then you're able to see how much of these affordable home loans you can access. And then thereafter, you're matched with affordable properties. Now, based on that, so how would you describe the affordable home loans and what offering does Absa have?
So affordable home loans, in our bit, it basically refers to a facility that can be easily accessible and is affordable in the sense that a majority of Kenyans can actually repay. They can borrow and repay the facility in a way that doesn't strain them. And there's a context to it in the sense that for the longest time since housing financing has been in Kenya, the rates have always been double digits, 14, 15. Growing up, I remember just seeing people paying at 30%, 27, 28. So really, that isn't affordable. So the parameters around affordable are, number one, that it's a single digit, interest rate. That then makes sense to call it affordable. And then number two, it's that it's predictable and it's stable. Because affordability also, when you're talking in the space of mortgage, it's a long-term facility of 25 years. It can start affordable and then become unaffordable during the length of the loan.
Yeah.
So it has to be fixed. So that it is predictable and therefore becomes affordable for the duration of the loan. So in that sense, then 9% is a facility that comes under 9%, that becomes affordable. And then also, it should address the concerns around how many people can actually afford to service it for the house that they want. Yeah. And therein comes the issue of now the parameters around, do you want to give a 9% facility to somebody buying a 50 million house or a 40 million house? Then again, it beats the principle of affordability in a way. And therefore you have to define the maximum to which that can be used, that facility can be used for. And most Kenyans, you'll find in that earning around 100, 150,000, 200, thereabouts. If you apply the 9%, then you're able to give them houses in the range of 10 million, 11, 12. And we said that we stretch it all the way up to 20 million. So together with a partnership with KMRC, then that defines what is affordable, that it's a house not worth more than 20 million. And then the interest rate is a single-digit interest rate. And in Absa, we are starting at 9%. And then for a period of 25 years, so that you increase the number of people who can qualify and service it for up to 25 years.
Okay.
Yeah.
Okay. That's good. So what I'm hearing is, because I know these different definitions as far as affordable is concerned.
Yes.
And when it comes to housing affordability, so across board, there have been various and multiple ways of defining it. Some would say anywhere, if you allocate 30 to 40% of your income towards your housing needs, then that's affordable. So as far as when it comes to Absa, so we're looking at a single digit interest rate of 9%, fixed for a term of 25 years.
Yes.
And the maximum price point for a house is 20 million.
Yes.
Okay.
Yeah.
That's good. So if you want to now get started, and let's say, for example, you have a family, is it possible for two parties, now a couple, for example, to make an application as individuals and access this financing on a separate basis? Or would they have to do an application as a household?
Okay. So, good question. The affordable home loan targets households. So, what that means is that as a couple, you can only qualify for one KMRC loan, the Kenya Mortgage Refinance Company loan, who are our partners in this case. So then you have to choose carefully as a couple how you want to use your ticket. Yeah, because it's only one. Then if you're a couple and you decide, you've sat down and have agreed that you will handle housing, I will handle other financial obligations, and therefore you take up the mandate of getting the facility. If you've also agreed that we don't need to both borrow together jointly, then you can still borrow by yourself and be the only loan applicant. However, if you're married, and married now becomes another subject altogether in terms of defining it,
yes,
then your spouse has to give consent for you to be able to actually use that house as a security. Remember, when you're borrowing or you're borrowing to buy, and the security has to be the house you're buying. Now, marriage means that your union is recognized by law.
yes.
That is the number one definition. So I'm coming from that point where you have a certificate, your marriage is registered, and therefore now if you borrow a loan, I'll have to give consent. If I'm your husband, or if you're my wife, you have to give consent that I can proceed and borrow under my name. So that comes under the documentation that is normally done by the lawyers in the process. You sign the spousal consent form, which allows you to use the family's property and attach a loan to it. But the other way is actually easier when you do it together jointly. Then in that case, there's no need for consent because both of us are borrowing together for that property. So we become joint applicants and we are able to proceed with the application. Okay. So those options are there. You can still borrow a loan even though you're married, but your spouse has to consent to that borrowing.
Okay. And when you're making a joint application, there's the element of assessing your income, right?
Yes.
So in this particular case, is there a cap in terms of for example, a combined household income that you'd consider?
So there is no capping. What it means is that we can come together as a couple and come to borrow.
Okay.
And my income is sufficient to actually pay and service the loan completely for the 25 years. Then in that case, we don't need to consider your income as my spouse. Yeah, because mine is sufficient. But you can still do the joint application because you want your interest put together in that loan.
Yes.
Remember, once the property is transferred, it will be transferred then to the name of the applicants. So in that case, it comes out in my name and your name as my spouse because we are both borrowing. There is a situation where if I'm the only one borrowing and you're my spouse, then that transfer can come to my name only. If you're not in the sales agreement, if you're not party to the sale, it can come in my name only. But still, it will still be seen as a matrimonial property in cases where the estate is being contested or, such eventualities, because we are married and there's evidence.
Okay.
So you can still put your income together and borrow, or we can still come together and only my income is used to actually service the facility. So both scenarios are on the table and they're okay.
Okay.
Yeah.
So if one party's income is not sufficient, then they can add the spouses as well.
Yes.
And then, so it would be considered as a joint application.
Yes.
Okay.
Yes.
And so ideally, if that's the case, then it means, for example, in an instance where both names will appear on the title of the property, and even during the application process, it means that from the get-go, from the onset, when they're signing the letters of offer, the sale agreements, then both names ideally should appear.
Yes,
at that point.
That is very critical when you're getting an offer from the seller. Whoever gets the offer, whoever's name is on the offer on the sales agreement, that is the name that will appear on the title. So you have at that point to agree as spouses who is purchasing the property. And if we're spouses, I don't see how, but it can happen based on your agreement as spouses that you buy that property. I have it in my name, and it's basically you agree on your side, then now come to the table and agree with the seller that we are both purchasing, put both our names on the sales agreement. Then in that case, the title comes out in your names. So in that case, the spouse who is not, both of your interests are registered on that particular transaction all the way to the end. Yeah.
Okay. And how would you, let's say again, you're married, but then you fail to disclose. So in this, let's just, put it into context. So I'm married, and then during the application, I decide that, let's say I want both of us to benefit, and then I don't disclose that I'm married. Is there a way that, the bank can find out? Are there any dangers as far as that is concerned?
Yes, indeed there. Remember, once you start servicing the loan, you could fail to disclose, and it sails through. So peradventure, it sails through. Those are some of the things that we capture in the letter of offer, in those clauses that are there, which we advise our customers to read keenly. When such material information comes out when you're servicing the loan facility, that puts in danger the transaction, because the spouse can come and contest and say, I never gave consent for you and the bank to actually charge the family property. Because if you are married, it becomes family. It's a matrimonial property.
Yes.
So if the consent is lacking simply because you didn't disclose that you're married, then the spouse can contest that that facility, they have nothing to do with it and stuff like that, or whatever manner of litigation they can bring up, it will expose the bank. So the bank at that point can sue you as a customer. Number two, yes, because you didn't disclose. And number two, the loan can be fully recalled, in totality, because of you failing to disclose a very material information. So the loan can be recalled, all of it, and said you have to pay the full loan completely today and finish it. So it's not in your interest as a customer not to disclose such things. But again, also the lawyers also who do the transaction help us to actually ascertain that particular space, if you're married or not. But some can fail to go through, depending on, it is always a moving target. You could start when you're not married, then you get married.
Yes.
It becomes a legal thing that we leave it to the lawyers now to just advise on what happens. The process could take even 2 years for that. Say you're buying an off-plan facility, you came when you're not married. During the transaction, we gave you an offer letter, you are not married. But in the 2 years you get married and you don't disclose. So a lot of things can happen in between. Before now we disburse funds to acquire the property and you start repaying the loan. So, but we normally tell customers that you have to disclose any that's the material information that you have to disclose, so that at any point you're not exposed as a customer, the bank is not exposed, and the transaction can be completed.
Okay.
Yeah.
Now, as a follow-on question to that, so sometimes, life happens, You've made this application to 2, 3, 4 years in, then unfortunately, one party, let's say if it was a joint application, one party passes on. So, and this is let's look at a scenario whereby my income was sufficient. So in that particular case, yes, the title and all the documents have both names, but then I was the one who was servicing the facility. Then unfortunately, I happened to, pass on. So what happens next?
So ideally, let's start with a scenario where you are the only borrower. You didn't bring in your spouse as part of the borrowing. So the loan is in your name, and you pass on.
Yeah.
We do require that we get notification of death, and the death certificate. Then we present that to the insurance company, and then they're able to pay off the outstanding loan at the point from which it was confirmed that you're dead, based on the documents that you present. So all loans, all mortgages basically are secured so that it covers the life of the borrower. In case they die, then the insurance pays off the loan. Then in the event that you have a joint borrowing, and the loan is actually Mr. and Mrs. or both of us together, and one person passes on, the insurance is still able to pay the facility because we are joint borrowers.
Okay.
Yes. So in that sense, if any person dies, the other one is not left repaying the loan. It covers death of either of the spouses. Okay. So if one spouse dies, the loan gets fully repaid by the insurance.
Okay.
The tricky part normally comes where you have you didn't enjoin your spouse in the borrowing. He or she is not part of the borrowing. Then you pass on. It becomes a case of, okay, say you have your two of you. We give you a quotation on the insurance that is paid. Remember, if you're single, the premium is less. If you're joint, the premium is more, almost double that you pay for the insurance, and you keep paying it every year based on the outstanding loan.
Okay.
Then some couples will say, no, because I'm the one who is repaying, cover me. It's a joint application, but you're saying cover me. I won't pay for her. You get? So, or I won't pay for him because he's not the one servicing. Then the one who is not servicing actually passes on. So and that person is not on cover. He or she is not on cover. You is on cover because it's for you who the cover is applicable to. You have to continue repaying the loan.
Oh, wow. Okay.
Because the one who passed on is not on cover. Okay?
Yeah.
What that does is that it immediately strains me or you, who is the surviving spouse, still repaying the loan. Because whatever financial obligations I was taking care of, because you're the one servicing the mortgage, have to come to you. It could be school fees, it could be black tax, it could be whatever it is.
Yeah.
It comes to you plus the mortgage repayment. So the chances of you defaulting significantly increase. You might start defaulting on the loan immediately because you have added responsibilities now on your financial income, on your source of income. So at all points, we normally say, please do a joint application and let's take cover on both of you. Because if that scenario happens, the insurance won't pay because they never received premium from the spouse who passed on. They were not on the cover.
Okay.
Yeah.
So based on that, that's one of the reasons as to why it's very important to disclose your marital status during the application.
Yes.
And then now, touching on the insurance premiums, so typically once the funds have been drawn down to the developer, then that's when the payments restart.
Yes.
So at that point, are these monthly payments, do they have an insurance component to it? Or will you be required to also pay like additional, additional sums as part of the insurance?
Okay, so there are two ways to look at it when it comes to the insurance cover. We normally cover the life of the borrower, then we cover the security that is that secures the borrowing itself. Now, there are two ways you can do it. It depends with the route that a bank takes. There is the one aspect where you can factor in that premium as part of the monthly installment. And then in that sense, when the customer is servicing the loan, there is a small portion that is like being contributed towards the renewal. We only renew once as a bank. We do it annually, and we do it for the whole portfolio that is there in the bank.
Okay.
So there is one anniversary date for renewal for life cover, and there is one anniversary for renewal of the property insurance. So what happens is that you're contributing every month in your installments toward that renewal date. Then on that renewal date, the bank collects what you have contributed and pays to the insurer. But what that means is that your installment will be slightly higher depending on the loan amount, because the premium depends on the loan amount and depending on the value of the house. Okay. So those two put together will increase your monthly installment. So that again also speaks to when I'm seated this side as a banker and I'm analyzing your financial income, I will then have to analyze you also an ability to contribute towards the insurance on monthly basis until when we renew it for the next 10, 15, 25 years. So again, you will see that portion can be small, but it can lock out a few people, those who are on the margin in terms of qualifying. So it can reduce the property you can qualify for, the loan you can qualify for. So it might lock out a small portion of people. Then the other bit is where we say, no, we will only look at the principal plus interest when we are analyzing your ability to service the loan. Then when it comes to insurance, you will pay upfront. So in both cases, you normally pay upfront initially so that the cover can kick in. And then now on the renewal date, in the option number 2, is you pay. You deposit money into the account. We invoice you, you deposit money into the account, then that's what we pay the insurance company. Where you do not have cash, we also offer insurance financing, insurance premium financing that will take care of that insurance for the renewal purposes. Okay. So those are the two ways that banks look at it. And then as long as the cover is on board, then you're good to go.
You're good to go.
Yeah.
So now if we're to break it down, so I've had this life cover.
Yes.
There is also a cover that basically takes care of the property in the event of fire.
Yes.
Then there is also the element of, is there also a retrenchment cover?
Yes.
Okay.
So that's an additional offering that is there that covers retrenchment. So it's purely and purposely for retrenchment. In the event that there is downsizing of the company, the company has to go notify the Ministry of Labor, get the necessary approvals, then conduct the downsizing. If you're caught up in that, then this cover comes in. It's an optional cover that we offer to the customer, depending on your terms of employment. Okay. So you'll find like those who are on contract, that doesn't really happen because your contract will be renewed once or twice, every 2 years or 3 years or 1 year annually. So you'll find that retrenchment really is never an option because the insurer, the company will pay you off for the remaining months. But if you're permanent and pensionable insurance and this event happens, the insurance company comes in, if you've been paying the premium, and they take over the installments, the monthly installment, and they pay it for the next 9 months.
Okay.
So during that 9 months, it gives you an opportunity to reevaluate your options.
Yes.
Do you want to sell the house? Is 9 months sufficient for you to get another job or get another income? So that 9 months reduces the stress that can happen to you if you start, getting knocks on your door that you haven't repaid your loan this month, month 2, month 3, and other things start kicking in. So it gives you room to weigh your options without pressure, and then you can decide what to do.
Okay.
Then when the 9th month kicks in, that insurance will stop, and then now you have to continue repaying the loan if you've chosen to continue in repaying the facility, depending on your circumstances.
Okay.
Then,
Okay. And so just going back, I know we are delving deeper on this, on matters insurance.
Yeah.
So the first one, which is life, and then the second one for the property, those are mandatory.
Those are mandatory.
They're already bundled up with your monthly repayments.
Yes.
Then the one for retrenchment is what now is optional.
Yes.
Okay.
Yes.
And so I'm also made to understand, because we had this during the previous session, it's also subject to your age. So if you're younger, then your premiums are likely to be less compared to somebody who's older.
Yes.
Okay.
Yeah.
Okay. That's I'm also learning.
Yeah. Then there's also the insurance that you take when you're doing construction. You could come and you've taken a construction loan.
Oh yes. For those who want to build.
Okay. Yes. So there's an insurance that generically is called contractors all risk insurance cover, and it covers the contractor, the construction site. It covers the workers there. It covers you against any claims in case the workers are injured. You have to secure your site, so it covers, if you've secured your site, then it covers you against proliferation of material, theft that happens and things like that. So that cover also, part of it, some of the covers that are there in the market, you'll also find it has a cover against defects, for the next 6 months or so. It depends with which cover you've taken, and most of the time you have a choice to choose which cover to take, because as the features increase or the benefits increase in that cover, the premium also goes high. So, but at the very least, you must have a cover during the construction period, so that it takes care of that, and you're not digging into your pocket in case anything happens around the construction. Then once you finish constructing, then the property insurance kicks in to cover the completed building.
Okay.
Yeah.
Okay. Now, I like that you've brought the subject of those who would want to, take the facility and build their own homes. And because I know it's also a very popular avenue for most of us. So in that particular case, when somebody comes to make an application and they want to build, is there a prerequisite that must be followed? So for example, sometimes maybe your uncle who is a contractor, and you have your cousin who can be the project manager.
Yeah.
Would you require them to use professionals both during the design and build stage? Is that mandatory in order for them to access the facility? And I'm guessing just from also a risk perspective, because obviously if you engage professionals, then the risk is significantly lower compared to, engaging your uncle and your cousin.
Yeah.
Yeah.
So that is a very touchy area because construction, most of us take construction because of the savings that you get on the construction. Depending on how you've worked your construction out, savings could be huge. Could be anything between 10 to 40% compared to somebody who is purchasing a straight up house. But most of the time you'll find it ranges around 20% thereabouts. Now, when it comes to construction, of course, there are requirements that need to be fulfilled. Most of these requirements are do not emanate from the bank. They emanate from the authorities. Remember, the government has a responsibility to ensure that you live in a proper house. Yeah. And therefore, you're not allowed to just construct anything and live in it they have a social responsibility as the government to protect life, even your own life. So they institute regulations around construction. And that means that you have to have approvals for your construction. Yeah, which means that the building plans have to be approved by the county governments. That's their mandate.
Okay.
You have also the structural drawings for those who are doing multiple levels. If you're doing a bungalow, there's no need for structural drawings. But if you're doing a property that sits on a slab and goes up, then you need structural drawings from the structural engineer.
Okay.
Who will say how sound the structure is, what it needs to be, and therefore we also have to get those approved. In the cases where it is only the building plans, if it's a bungalow, then the architect is sufficient. As long as it's done the drawings, you present it for approval. The thing about those is that you've mentioned about professionals, and you're bringing in the sticky bit about people you know, cousins and stuff like that, relatives.
Yes.
We really don't have a say much in that, because the thing we check for is, are they registered with their respective bodies?
Yes.
Like the Board of Registration of Architects and Quantity Surveyors.
Yes.
So they have to have, first of all, they were they qualified to be architects. So they have their certificate. And then they have licensed, a license that is renewed every year by their respective bodies. Then if they present those documents and they are valid and they are current, then that is a professional. They are good to go. But we go ahead and check if there are any outstanding issues against them.
Okay.
Because if there are standing issues against them, they won't get their license renewed by their body.
That's true.
Yeah. Number 3 is that you'll have to present these project things that you've put together with their certificates and everything, together with the approvals to NCA, National Construction Authority, to approve. Now, you see, up to this point, the bank even hasn't come in. So whether you're taking a mortgage or not, these are things that you have to meet their regulations. So you go to NCA counter check all that and ensure that it sits well with the regulatory body. So these are the things that once you're done, you come to the bank, and then we are able to say, okay, fine, you've ticked all these, they're okay. Then now we are able to proceed and engage now to disburse funds for construction.
Okay.
Yeah.
And if somebody is building in the rural areas, would they also qualify to get the facility? And if so, would it be, let's say they can get up to that 10.5 million? Would that be considered, or if it's rural area, it's a different?
Yeah, so urbanization is increasing. I mean, not at the rates we want, but urbanization is increasing. The key thing that a bank looks at is definitely you start from the end. As you get out of the major cities, you start at the end of it. If the customer is unable to complete repayment, if they default and you have to sell this property, how quickly can the bank auction that property or sell it? How quickly can the customer get a buyer to buy it, And we both agree, as you get out of the urbanized centers, urban major towns and everything, then that risk now grows, significantly grows. It is not easy for me to come, or any bank to come and say, we want to auction this particular house, and the ecosystem, the place where our customer lives, next door neighbors, they have been there for ages, 50 years. It's basically a whole community. No one will buy.
Market.
None of your neighbors will buy your house.
Okay.
There are so many dynamics around that area that if somebody buys, they're most likely your very close relative or your friend or your neighbor. So it becomes tricky. You will never get that property offloaded. So that means that as you get out of the major towns, the loan to value ratio reduces.
I see.
So the customer has to put in more towards the contribution of the whole deal. So whereas here in major towns, you'll get up to 105% financing because the security can move faster. If you get way out, then it becomes an issue of up to 50%. We go 50-50 or we do 60-40. It depends with what we'll see as our appetite of risk for that particular place that is in the rural areas.
Okay.
But our guideline is normally around county headquarters, around municipalities, the old municipality boundaries.
Okay.
Those are places that we can consider outside the major towns.
Okay.
Yeah.
Okay. That's actually a very important point for the audience to note.
Yeah.
Okay. Now, moving on to the part where now you start making your repayments. So, for example, you saw a really nice project. It was off plan or still under construction. Then you went ahead, you got vetted, you got your offer letter. Then now you have to wait until the development is complete. So once this development is complete, then the bank draws down the funds. So of course, there's a procedure, but at the end of it all, the funds have been drawn down. So typically, people are usually not very clear in terms of at what point do I start making the repayments? Is it at the point when I receive the offer letter and I'm told, okay, I qualify for this amount and this is, an estimate of what my monthly repayments will be? Or is it at the tail end?
So when it comes to off plan, it's a bit tricky based on where as an industry, housing industry, and we've come from. And also the issue becomes how soon can the house be completed? So typical bank won't give funds against an incomplete security. So if a bank finances you for a property that is not complete, then the bank goes ahead and says, we can take over and we can give you funds to access and buy this incomplete property as on the condition that you will complete it. So then we'll package for you a purchase of the incomplete house plus a construction to finish it. But when you come now to developer's case, it's a massive scale. It's 300 apartments.
Yeah.
They are going all together. So that is not a product you can sell. You can do that for a bungalow or a maisonette, but you cannot do that for things like apartment or where the titles are not ready, because the bank has to get the title and then release funds against a complete building, a complete structure. So in this case, the bank can give the developer some comfort that we have looked at the financials of the customer and they do qualify. So just as, and we give what is called a letter of intent, that we intend to lend to the customer on based on them fulfilling several conditions, key to which is the house or the unit they are buying is complete. Then at that point we can release funds and we can finance. So you will find that the letter of intent is a bit flexible and it puts the onus on the developer and the customer to hacken and finish the construction faster. So you'll find that it's not really time bound. But if you're talking of a letter of offer is binding. It has a time period that the customer has to fulfill these conditions within the next 30 days. Otherwise, the offer from the bank lapses. It can only be renewed if there are good reasons why it went beyond that. Could be valuation took long or a couple of issues. So we do not issue letter of offers against off-plan financing. So we have to see that it has reached a certain level of construction, the developer is of good repute, that they will complete the construction and everything. Then now we are able to upgrade it and give you a letter of intent, but when it's done, we upgrade it to a letter of offer, and then now we are able to proceed with the transaction. But in cases where we have agreements with the developer, or we are financing the developer's Absa, we have the mother title with us, we can proceed and it's safe to lend space for us because we are holding the title. We can proceed and have such arrangements where we are financing off-plan and stuff like that. Yeah,
that's very important for the audience to note, because majority of people, typically people won't have 8 million, 10 million Kenya shillings just lying around to be able to buy property cash.
Yeah.
So then it's good for them to know that there's an option of, yes, even if it's under construction, once you've been vetted, there's that letter of intent that can be issued to you. And then upon completion, then the funds can be drawn down.
Exactly.
Okay. And now, so we tackled this with your colleague from, the industry during our other session.
Yes.
So what would be somebody's option if they are unable to pay? And the reason as to why I'd like us to also just go through this again is because most people usually have, so there's a lot of stigma around mortgages.
Yes.
So then the assumption has always been, yes, the bank will give me the facility if I qualify, but then they're after my property. They want to come and sell my property. So that's why it's very important for us to, just tackle this again. So what options are there before it gets to a point where now a property is being auctioned?
So,
and it could be for various reasons.
Yes.
Yeah. Let's in this case, let's assume you've lost your source of income.
Yes.
Yeah.
So the options that are available are pretty much vast, but they all drill down to two things. Are you able to continue servicing, or is that mortgage, will it continue being repaid until completion, or will the property, are you able to offload the property? So in the first instance, where we're looking at can you continue servicing, a lot of things come into play. Number one, have you made extra payments before? Did you make lump sum payments in the previous several months or years that you've paid the loan? You could have downpaid even in advance. You're way ahead of schedule.
Okay.
And therefore you're able to negotiate for a lesser monthly installment that can suit whatever source of income you have now. Because remember, we gave you an offer to repay the loan in 10 years or 20 years. You probably had the windfall, you've accelerated, you're way ahead of the schedule. That is something that can be looked at so that you don't lose your property and you're able to service that loan because you had made several advance payments. The number two, you are in a situation where you probably, we did it as a joint couple, and it is my income that was being used to service the facility. We never considered yours. So in that case, the spouse is still earning, can come on board. And now we analyze them based on the outstanding balance. You could have taken a loan for 10 million. It's at 5 million outstanding. The repayment for 10 million and the repayment for 5 million, it's basically almost half, the monthly installment.
Yeah.
So your spouse could still have some income, which they can come in and take over the repayment of the loan, so that you don't lose out as a couple, as a family. You don't lose out on the property. So we can analyze and see if your spouse is able to take over the repayment of that facility. Then you also have cases, but those are unique cases because now we are at a situation where you want to keep the property within the family.
Yes.
There is the aspect of also kin. It could be your brothers, could be your parents. If they are able to come in, those are things that can be considered on exceptional basis.
Okay.
Yeah, as long as there's commitment around it and we have weighed the risk around bringing such parties in, that they are able to do that. Alternatively, you have the ability now to, if all that fails, you have the chance to go out and actually put the property on sale. We leave it to you. You can sell it to any third party. And as long as you bring the terms of agreement that you have, the sales agreement and everything, so that we consider the new offer, then we can hear from the new buyer how they are going to repay. Are they taking over the loan as part of the sales process?
That's an option.
That's an option.
Okay.
You can bring in somebody who has the ability and you sell it to them. So they take over the loan and as long as they meet our requirements and you remain with whatever agreement you have about the excess value of the property that you take home with. But at all times, remember the law is very clear. You can't auction or you can't sell off a property at less than 75% of its open market value.
Okay.
So those are the options that a customer really has. And we try and make it as smooth as possible, as long as the customer is also accessible and, and comes to the table we discuss.
Okay.
Yeah.
Okay, so what I'm hearing, there'll be extensive efforts.
Yes, not to sell.
To have those discussions.
Yes.
And I also want to believe this is because the bank is not in the business of, selling properties.
Yeah,
that's not your core business.
In fact, when we analyze a customer at the beginning, before we start, that is the first thing we normally look at. The property. How viable is it at the time of auction? Because we don't want a stock that is just building that cannot be offloaded. So we are no bank really is in the business of acquiring assets, then accumulating them, then selling them. I think that is also why that law came in to safeguard the borrowers, that you can't sell at anything below 75% of its value. Okay. Then that makes the banks also choose the collateral that they are getting, quite diligently.
Okay.
Yeah.
And the other beauty about these affordable home loans is, let's say, for example, in a setup where it's a family setup, and unfortunately, one of the spouses passes on. When we talked about the life cover, if the life cover steps in, and in the event where there were children, at least there's that continuity in terms of stability. Yes. They don't have, unlike where, let's say, for example, you were able to get started, but they decided to continue renting. Should such a scenario happen, it means that if your partner is not able to, continue sustaining that lifestyle, you'd have to move out, which at some point would destabilize the kids.
Yes.
So in this particular case, because of the element of insurance, then there's that element of continuity.
Yes.
Okay.
Yeah.
That's really powerful. And again, also, when you look at the monthly repayments, which is what we always emphasize, they are so flexible and also affordable because of the tenure and also the interest rate.
Yes.
So then they'd be able to match what you'd be paying as rent.
Yes.
As long as you have that deposit in terms of getting started, then the rest of it just becomes, we usually like to say, like, sort of the bank becomes your landlord. Only that it's a better landlord, because a typical landlord, if you default, even if it's 1 month, they're going to close, send auctioneers, lock your doors.
Yeah.
But then in this particular case, there are a couple of other remedies before it gets to that point.
Absolutely.
Okay. Then another question would be, so what would be the reason as to why somebody's application would be rejected? What are some of those parameters that the bank can look at and be like, in this particular case, you don't qualify?
So, number one is character.
Oh, wow.
Yes.
Okay. That's a new one. Yes.
It's not about how much you're demonstrating on your pay slips and on your business income that you have. Character is the main thing.
Okay.
Because if we go through your CRB report, we go through your bank statements, and you're not repaying facilities despite the fact that you have income, you are defaulting on facilities, choosing when to service them and when not to pay, that becomes an indicator that we'll have a challenge in you servicing the loan. So character is important. You have issues like bouncing checks, you have issues like pending bills, outstanding, or of your delayed payments to your suppliers. All those things come into play first.
Oh, wow.
That character is so important.
Okay.
Yeah. But beyond that, is basically a mismatch between the amount you want and the property you're going for.
Okay.
So your source of income cannot support the property you're going for. That becomes also something that can make you not qualify. The issue is, it's so hard to walk into a bank and you have a source of income and we tell you, no, you don't qualify. It could be that the property you're buying is actually more than what you can afford based on the documents you've submitted. Then there is also the issue around the property that you're buying. Is the title there? Are there any litigations around it? What's the reputation of that estate that you're buying into, and that project that you're buying into? So you could have qualified financially, but now the security that comes to the bank comes into play. how stable is it, how viable is it, how does it have any issues around it. So that can also be something that you can say you didn't qualify, but it's not based on your financials, it's based on the collateral, it's based on the security that you're giving the bank.
Okay.
So those are basically the issues that can stop, can stop your journey towards home ownership. But it's easy to unlock once you sit down with your banker. They can advise you on, what to work on.
Okay.
Yeah.
And I like that you've talked about character. So sometimes you could have that mobile loan
Yes.
that you never even thought of, and you're like, okay, it's not a big deal.
Yeah.
And then now, when it comes to such an instance where you're about to make a big decision, it comes back and bites you. So you should always ensure that you're in good standing as far as your credit score, your credit history is concerned.
Yeah, because remember, even right now we are in a regime where it's risk-based pricing. So it's based on the risk of the customer that sits before you.
Okay.
And the one who is better, gets a better interest rate.
Yeah.
The one who clearly you can see on the documents that are presented, especially the financials, that they have issues around servicing, meeting obligations, then they still get the facility, but priced higher.
Okay.
Yeah.
So if somebody is employed on a contractual basis, because sometimes we do get clients who say, okay, I'd like to get started, but then I'm on contract. Their assumption has also been that if you can only access the facility if you're like sort of permanent and pensionable. So do you consider applicants who are on contractual basis?
Yes, we do consider, because what they require to do is to demonstrate that they're employable. So if you've been on contract, what is key is how many times that contract has been renewed.
Okay.
Chances of you getting, if it's your first contract, say you're young, you're straight from campus, or it's your first job, you're young, and it's your first contract, chances of you getting a long-term facility are very minimal. But once you build that employability history, then it demonstrates that you are actually, there are no gaps in your employment. You're able to get a long-term facility. That's where the mortgage comes in. So what I will say is it's on a case-to-case basis, but as long as there are no gaps in your employment and you can demonstrate through producing other contracts that you've had, even though you've changed employers, you're still in employment and you're proceeding, we'll give you a long-term contract for sure to service we'll give you a long-term facility, that's the mortgage, to service the loan, to your journey towards home acquisition. So we have a package for those who are on contract also.
On contract as well. Okay. That's good to note.
Yeah.
And then even as we come to the tail end, so sometimes we do interact with, again, customers who are running businesses. And it could be, SMEs or like a large scale type of business. But then for some reason, maybe they don't pay themselves a salary. So they just, draw funds, which realistically speaking is how many people run their businesses. So in that particular case, what would be the best way for them to get started when they're being vetted? First of all, do they need to have a salary? So in the form of like a pay slip, which they can produce to actually say, this is how much, I take home. Then secondly, in the event that they don't, what would be the next steps for them?
Okay. So for SME, especially if it's a sole proprietorship or if it's joint and it's a family, some family outlet, what we can distinguish between the owner and the business and the financials, because it's a sole proprietor, is an SME who runs everything. So in that case, we analyze the statements, the business account, and we put our discount based on the taxation aspect, the living expenses, and all that. And then we see what is the disposable income that you have, and then that is what we'll use as your ability to service the loan. So you don't need to have a pay slip in that case. Okay. Where it gets tricky is where you have joint ownership, joint proprietorship, or it's even a limited company, and you are several directors, and now the business account is one, but the interests are different directors who are not related and stuff like that. So in that case, it's normally good that there is, yes, you're doing your drawings we can check and confirm the drawings from your audited accounts. So most of the time in that space, we might ask for audited accounts to check what the drawings are. And we normally recommend that if you know that that's the direction you go one day, then you start having your payroll put together. Yeah, so that it helps you when you're trying to borrow as an individual, because even as a director, you have your needs to home ownership.
Yes.
So then you can institute that in your company and ensure that you have the pay slips in place. So what happens is that if we get such a scenario, we normally give you leeway to basically go and put that in place, institute it, have that done for, let's say, around 6 months or so. And then now we can work with that as something that is there. Because without that, then other directors might not be comfortable with guaranteeing the facility that you borrow or things like that. So we give you room to go and institute the payroll and just have that in place. But otherwise, we use the financial accounts, the bank statement, and where the facilities are, the chunk that you're borrowing is bigger, the loan amount is bigger, then, or your turnovers are big, it's a bigger company, then we also ask for the audited accounts. Then you're able to see what you can actually qualify for.
Okay.
Yeah.
So if somebody starts building their profile, let's say, for example, now they start paying themselves a salary, and after 6 months now, it becomes easier for them to get started. Will they also be required to still produce the statements from the company, as much as now they have a salary? Because now it's two parties. There's them themselves as a director of the company, but also as an employee, whereby they're earning a salary. So would they still be required to produce the statements and documents for the company?
Yes. So in that case, whatever salary they are drawing, they can't channel it to the business account.
Yes.
They'll have their own personal account.
Yes.
So that's the account we will look at.
Okay.
Yes, we won't look at the business account. Yeah, it's only in exceptional cases where you find that the business is, depending on the size of the business, that come into play and say, probably based on where the business is it a going on concern? The health of the business itself, even though you're drawing a salary, but is the company going to be there? If it's a small company, for the next 5 years, for the next 10 years, then that informs the period we can give you to service the loan.
Okay.
Yeah.
Okay. Thank you very, very much, Elijah, for all those useful insights. I'm sure our audience and our customers will find them very useful.
You're most welcome.
Yes.
Yeah.
So what would be your parting shot if somebody's watching this and they're like, okay, I've understood one or two things. Perhaps I'm an entrepreneur. This is where I need to make some changes in order for me to be able to get started in the next 6 months or so. We are towards the end of 2024. So new goals for the next year. What would you tell them?
Now, I will say that for the longest time, we have struggled with getting home ownership going. And that can also be translated and can be seen in the number of mortgage accounts that we've had as a nation, as an industry.
Yes.
It's really plateaued. It's growing ever so slowly over years. And that has been because we don't have, number one, affordable loans, affordable mortgages, and number two, we don't have affordable houses. Because if the lower middle income and lower income earners are not able to get a stock in the market to buy, then naturally the mortgage industry doesn't grow. But now we have intervention through KMRC, of which Absa has partnered.
Okay.
I will say that Kenyans should actually look at it as an opportunity to get into that journey of home ownership. Yeah, we will be working with you all the way. This is a facility that is, really straightforward. It is fixed. If you're going to pay 50,000 per month for 25 years, that is it. You're guaranteed. So even developers have seen that and identified that, and they have come to start producing a lot of stock that customers can get. The 4 million houses, the 5 million houses, the houses below 10 million. because the KMRC facility is at a maximum of 10.5 million. The stock of houses below that price is ever increasing.
Yeah.
So I would urge Kenyans to get into this discussion. We shied away for very long, but the product is here, the product is ready, and both the supply and demand side is actually putting their house in order. It's a good time for Kenyans to start that journey towards home ownership. And basically, we are there. We want to hear your story when you're done.
Yes.
Because that is what we want to be.
Yeah.
When you start and when you're closing down, when you're finishing your journey towards home ownership.
Okay.
As Absa, we want to be there, and we're willing to be there.
Okay.
Yeah.
Thank you very much. So on my end, it will be as usual. Please visit rentsco.africa. Use the calculator. What it does is that it shows you the approximate amount of which you can access. Then thereafter, it also shows you like an approximate amount that you'd be paying on a monthly basis. Then you also get matchmaked with properties within your affordability range. So that means you don't have to look at everything, and we've removed the guesswork. So you now know properties within your affordability range. So thank you once again.
You're
and
welcome.
Looking forward to working together.
It's been a pleasure.
Yeah.
And let's get into this space. I love what you're doing together with your company.
Yes.
And educating Kenyans around home ownership.
Yes.
So we'll partner and continue partnering.
Okay.
Thank you.
Thank you, Elijah.
Yeah.